If you want to protect your money from the volatility of the stock market while still ensuring that the growth keeps up with inflation, then money market funds could be for you. Now, in order to maximize the return on your investments, you need to take some risk. When you have long-term time horizons, you can afford to take a higher degree of risk because you know that you'll have enough time to ride out the volatility of the stock market. And as I've covered in my most recent video, the default funds that pensions are invested in with pension platform providers gradually de-risks your investments as you move closer to your target retirement age. And the traditional way of de-risking your investments and to smooth out volatility has been to gradually increase the proportion of bonds in your portfolio. If you are planning to retire at 65 and you live to the ripe old age of 95, then that's 30 years that your money needs to last you for. The worst thing that can happen that can really impact your chances of your money lasting versus running out of money too soon is a market crash as soon as you retire. This is known as sequencing risk. So it might be a good idea to protect the money that you will need in the shorter term from losses, and while at the same time ensuring that this money that you are protecting for the shorter term use does have some growth. You can continue to go higher risk on the money that you're not touching for the longer term. So for less risky investments, to protect that short term money, you have a number of options. Government bonds. The first option you have are government bonds, which are called gilts in the UK, and at the time of filming, they are yielding around 4%. Or if you go into the open bond market, yields can be even higher. But bond prices can be highly volatile, and you could still be hit with a capital loss even when the income is stable. Cash savings. Now, cash savings are of course the obvious option in order to protect your money from losses, but it's incredibly difficult to keep pace with inflation when it comes to cash. And the trouble is that unless your money is within a cash ISA where returns are often lower, you end up having to pay tax on the interest that you make on the cash. Basic rate taxpayers have a £1,000 tax-free allowance every year, whereas higher rate taxpayers receive just £500 of tax-free savings allowance. And if you earn over £125,140, you get absolutely no tax-free savings allowance. Money market funds. Money market funds can be thought of as a viable option between these two, between bonds and cash, because they offer the kind of income that are similar to gilts, similar to bonds, but without the complexity. And these funds also mitigate a lot of the risk that can come from the fluctuations in the bond market. And money market funds can be held within ISAs and pensions. The key point to understand in order to get your head around what money market funds actually are is that they are made up of a diversified set of safe bonds that are maturing in the near term, that are maturing soon, normally within a couple of months, meaning that they can earn income on your cash with very minimal risk. Now, there are two kinds of money market funds, short-term and standard. Short-term funds are the lowest risk. The fund managers try to ensure the highest possible level of safety when it comes to the certainty that you'll get the returns you expect by ensuring that the bonds that they keep within the portfolio are both short duration as well as high quality. Standard money market funds generally have slightly higher returns because they comprise of bonds with a longer maturity date. What are the best yields currently? Now, you can currently get money market funds that are yielding over 5%. An example is the Royal London Short-Term Money Market Fund with a yield of 5.06%. And another example is the L&G Cash Trust, which yields at 4.97%. And also don't forget that these funds do have small fees associated with them, which will eat into that yield that you'll ultimately get. But you can mitigate against the overall fee that you are paying by choosing a platform provider that charges a flat fee as opposed to a percentage. So something like a interactive investor or free trade. Those are examples of platform providers that charge a flat rate. Let me know in the comments if you have experience of money market funds and what role that they play in your overall portfolio. Thanks for watching. Until next time, hwyl fawr am y tro.